Many of you have asked me for an update on Ouster. Ouster is finally getting recognized. The stock is up almost 50% year to date. I was one of the early people to talk about the stock, and I used to see a lot of posts on X claiming those are the best stocks to bet on robotics, the best stocks to bet on physical AI, but then no one talks about Ouster. And I used to tell them, how could you possibly miss Ouster? Well, all of a sudden the stock is getting recognized. People are talking about it on X. And I'm very happy to hear that. And I still believe the stock is fairly under the radar. So I'm going to talk about it again, give you an update. And I really hope you enjoy it as always. Now, Ouster is a bet on physical AI. If you look at automation in general, robotics, all of them, they all need sensors to be able to sense or to be able to operate and see a lot of things. So for example, Ouster is used in industrial applications. They have a partnership with Amazon where Amazon uses the LiDAR sensors in a lot of the robotics in the warehouses. They recently got more into automotive. They also got into humanoids with the recent acquisition of Stereolabs. So now they don't only have those LiDAR sensors, but they also have those cameras. And this is really, really big. China is way ahead of the United States in robotics, especially in humanoids for defense applications and other applications. The US wants to catch up, and Ouster is one of the leaders right now in humanoids. And I truly believe humanoids is likely the next big trend, and I studied it a lot recently. So about 40 to 60% of the humanoid cost is in actuators, and I recently invested in an actuator related stock, but then 10 to 20% is in sensing and perception, where Ouster has a massive edge. So the company is very well positioned to benefit from physical AI and automation in general. But my favorite part of the business is smart infrastructure. So this is them installing those sensors on a lot of intersections and a lot of, you could say, traffic monitoring systems for the World Cup. They got a lot of contracts. Now, there's a reason why this is my favorite is because it's not only a hardware-related sale, but it also comes with a software to be able to monitor the traffic. So over time, Ouster will collect much higher margin and much more recurring revenue than just a company being a cyclical hardware company. We can already see it with the gross margins increasing from 1%. Now it's about 43%. This is very impressive for an industry LiDAR where people believe there's a lot of competition. The company is putting 43% because they have a technological advantage, but they also have that software revenues, which we don't know what percentage of revenue it is, but I believe it's been increasing, and that has been helping sustain gross margins in general. Now, very recently, they came up with a very new product called Ouster Rev 8, and this is mainly the world's first color LiDAR. So LiDAR before wasn't really colored in this way, and this one is colored LiDAR. It will be able to sense much more, and it's pretty much puts the bear case to sleep for LiDAR, which people didn't like it for this reason. Well, now you have everything in one LiDAR. Ouster is the only one. They've been working on this project for a while, and they should have put it up like in August of last year, and the market was giving them a hard time about it, but they were taking their time to do it the right way, and they did it the right way, and it's a pretty amazing product. It's gaining a lot of traction. They even listed the partners that they're shipping them to. They started shipping them recently. One of those partners is Google, which is very interesting to me because Google used to use the old Ouster LiDAR sensors for Google Maps. So if you've ever seen the street kind of a area on Google Maps and you see how clear it looks when you look at someone's house or at a street, well, that was mapped using an Ouster LiDAR. But now they're going to use the new LiDAR. Same thing with Volvo, same thing with Serve Robotics, which uses the Ouster LiDAR. So a lot of them are upgrading to the new LiDAR version, which is expected to be cheaper than the previous version, much better and much more scalable for them to gain competition. So that's not going to really increase their margins. It could potentially be the opposite because it's cheaper than the old sensor. It's colored, it's much better, but it's designed for them to take market share and to expand, especially in the automotive segment. Now, talking about competition, I'm going to very quickly mention this, and this is the whole case, which is mainly the bearish case, that Ouster can't really win because of how cheap the Chinese sensors actually are. So whenever you're doing a humanoid or you're doing anything with automation, you don't really care what kind of sensor, if it's made in the United States, made in China, you could just put it in. You want to do it as cheap as possible. And Hesai Group is the leader in LiDAR sensors and sensors in general, and it's cheap and it's actually very, very profitable. So people believe that Ouster stands no chance. And that actually makes very perfect sense. But those people are missing two main things. The first one is that, especially right now in the United States, if there's only one issue that both parties agree on, this is pretty much China and competition around China and national security around China. So last year in July, Hesai Group was blacklisted on the US government because they believe they're working with the Beijing military. They blacklisted the company. So the Hesai Group can't really be used for any defense applications. Anduril can't use them. They use Ouster LiDAR, by the way. Shield.ai, they can't use them. They have to use Ouster LiDAR or other LiDAR companies that are certified in the United States. They can't use Chinese LiDAR for monitoring traffic or for anything that has to do with defense-related applications. But those sensors are still being used in cars and in other things because they're very, very cheap. But the government is also trying to phase them out as well. And recently, as of December 2025, they launched a new bill which seeks to phase out Chinese sensors in self-driving cars due to space hack fears that they fear if there's any conflicts that could just turn them off or hack them from space. And that's a big problem for the United States in general. So no matter how much cheaper the LiDAR sensors are in China or anywhere else, the United States does not want to be dependent on them. And that makes Ouster the preferred choice and the largest LiDAR company, Western LiDAR company, mainly in the Western Hemisphere, but mainly in the United States. So that kind of gives Ouster a moat or a competitive advantage, you could say, in an indirect way, in a way that most people were not expecting it. But that's one reason why I decided to invest in the company. Now, this company is not perfect. There's some risks. One of them is dilution. I'm not a big fan of dilution. I say it's the enemy of long-term investors, but to me, Ouster is more of a speculative stock. I told you guys, and normally companies in their early stage of the cycle, they're losing money, they dilute some stock, but once they turn profitable, dilution ultimately slows down, and sometimes they even start buying back stock. So dilution has been crazy with Ouster, about 2 million shares every single quarter. Last quarter, it was much less. It was barely 1.2, 1.3 million shares. So dilution has declined for the first time. And I really hope it continues to do so. Now, they have a really good cash position, about 173 million. So they don't really need to dilute anymore. I believe the company will be profitable very, very soon. The last quarter was very encouraging. The company grew 49% in revenues, but it was down 22% sequentially. So a lot of retail investors, they got upset and they sold the stock on the open. And I tried to tell them it's down 22% due to them receiving one-time royalties in Q4. So they got some IP royalties. That's not going to happen every quarter. It inflated Q4, and then Q1 relative to Q4 looks really, really bad. But if you look at it year over year, the company grew 49% revenues. That's pretty impressive. The GAAP gross margins are still expanding. They went up 200 basis points year over year. Profitability is looking much, much closer than it ever was, in my opinion. If you look at the income statement for this quarter, they lost about 19.2 million in terms of income from operations. I like using income from operations because some companies like Ouster gets 2 million a year in interest. I don't want to count interest. I want to look at the core business. So they get 19.2 million in operating income. Now in December, which is last quarter, it shows a profit of 904, largely due to the royalties, which you can see the one-time royalties. They don't get them that much. They got 21 million, which inflated the quarter. If you adjust for the royalties, Ouster lost 21 million last quarter. This quarter, they did 19 million. So they're improving losses about 2 million every quarter. And based on my calculations, they should be profitable in Q2 to Q3 of 2027. And I believe the CFO agrees because he discussed it on the call. And he said, we expect somewhere within 2027 to starting to hit the profitability stride. So the company is within 1 year of profitability. And hopefully once it becomes profitable or at least break even, the dilution will be minimized because it's been extreme and I don't like it. But I hope it will become less and less over time. Now, talking about the upside, it's 30 to 50% revenue growth. This is the company's guidance. And I think they could do it for many, many years to come as the company, again, is riding a massive tailwind in humanoids, industrial automation, and physical AI in general. They only make 170 million in revenue every year. 170 million is nothing. It's only like it was $1 billion company. That's nothing. They can grow 30, 50% for many, many years to come. But I believe, despite Ouster going up recently, there's still a gap of you could say misunderstanding in the market because the analysts, they expect Ouster this year to grow 30%. I personally don't see it, Even though they grew IP last year and it inflated the growth, I don't see how they only grow 30% with the recent acquisition of Stereo Labs or the physical or humanoids or cameras, you could say. They were growing 35, 40, 50% before the acquisition. With the acquisition, they should grow at least 40% in my opinion. So if I'm right on this assumption, Ouster could end up growing much more than 30% and the stock could end up being about 10 to 15% cheaper than where it is today. But if you look at the valuation, and I like using enterprise value to sales because the company is not yet profitable, it should be profitable by next year. So on a sales multiple, it's trading at 6 times sales. And I've been saying this for a while, but 6 times sales is really not expensive, especially relative to other stocks. But if you just look at Ouster, for 30, 40, 50% revenue growth, physical AI, they have the moat around the Chinese risks within the United States, humanoids, all these things for 6 times sales. I don't think that's too much in my opinion. So this is my valuation model on Ouster. I put in 170 million. They got it last year for the next 10 years. Because this is a long-term investment for me, 35% annual revenue growth. I believe this is highly, highly achievable. On only 170 million in revenues, that's nothing. I think they could do it. And I would not be surprised if they even do a little bit more than 35% on average. But taking those numbers, we get 3.4 billion in revenues in the next 10 years. Okay, the current enterprise value is about $2 billion or $2 billion. Okay, so we're gonna make 2 assumptions. The first one is that it trades at 5 times sales. I think 5 times sales is fair. So we take 3.4 billion and we time it by 5 times sales, which is multiple contraction. We get a $17 billion enterprise value. The current enterprise value is about $2 billion. We divide it by $2 billion. You get about a 750% on the upside, or like a 7x, almost an 8x over the next 10 years. That's not a bad return at all. Now, if you use 10 times sales, you get a $34 billion enterprise value, and you divide it by a $2 billion enterprise value. That's about a 16, 17x over the next 10 years. So despite the stock going up recently, I personally don't believe it's overvalued. I would not be surprised if you see profit taking. Again, I'm not hyping up the stock and I'm not telling you FOMO and go all in. I'm not telling you what to do at all. In fact, I'm just sharing my opinion. And anytime you want to potentially invest in a stock that's up so much on the year, you have to be careful. So for me, I always start with small positions and I dollar cost average into the company. I started at $21 and I dollar cost averaged up, and that's what I try to do. And I share everything I do in my group, and the stock I told you about on actuators, I share it in my group as well. This is the link if you're interested. Thank you very much for watching. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.